All right. So, Brian, what's going on with the tape today? It's a
It's
little
almost like
choppy.
it's definitely choppy. It's probably since about 11 o'clock, it's pulled back fairly hard. And I don't know if people are anticipating the Fed news coming out, or is it the rising interest rates? Hard to tell. The
Yeah,
dollar is really strong today, too.
yeah. I mean, that's we've been talking about this now for some time. Here's the dollar index. This is what Brian's referring to. This is a daily chart, and the dollar, it doesn't move linearly a lot of times. So it's one of those widowmaker trades, like silver and some other things out there. One of the clues that I think is worth noting is kind of how Bitcoin has been acting. I'll quickly show this to you guys. Well, let's first bring up yields, because you mentioned yields, and obviously we've got the Fed tomorrow, a whole lot of earnings between now and Friday, and then on Friday we get the jobs report. So yields are up today. You can see that the 10-year currently trading around 460-ish. And then on the 2 year, so the short end of the yield curve, shorter end, that's basically looking like it wants to go to a little bit above 5 at least at this point. So that's probably what the market's not liking, would be
Yeah,
my guess.
I
The
would
other
agree.
point that we can make here, and you guys will have to squint a touch on this, but basically, if you look at this, I'm going to try to make it so that you can see it as best as possible. So just look to the right hand of this chart, everyone. So what we're doing here, we're taking Bitcoin, which is a good risk on, risk off measurement tool, if you will. It sniffs out, sort of risk off pretty quickly. And also when risk comes back into the market, meaning when it's time to buy things again. Bitcoin is the blue line, and the blue line, essentially, you can see if you look at it closely, it's back to below, actually it's not below the range it's been in. But the NASDAQ 100, and I threw in NVIDIA for shits and giggles, it's the same chart as a NASDAQ 100. I mean, literally. Those would be the other two lines here in sort of, I guess, greenish, teal, and orange. You can see how that bounce is now potentially coming under some pressure, and Bitcoin's kind of leading the way here. So if you look at Bitcoin, and this is not we're not going to talk about Bitcoin here today. So for those of you that have uh, uh, are not too into that, don't worry, I'm not going to scare you with that. But this is where Bitcoin's trading right now. And again, it's a little bit of a leading indicator to what risk assets do. Not always, but I think at this point it kind of could be. So anyway, just thought we would point this out. Any last thoughts on any of this, Brian, or are we ready to dive in?
I
You
think
tell
we're
me.
ready to, I think we're ready to dive in. I think we just have to wait to see what tomorrow's presser is going to tell us, give us any clues on what they're planning on doing. But we're at a critical junction, just based on a lot of different charts, and so it'll be really interesting.
Yeah, for sure. I just want to quickly recreate this, and I agree with you, Brian. Tomorrow is important. This is, you can see Bitcoin tends to lead the NASDAQ. So like Bitcoin actually topped out a few weeks before the NASDAQ, and then it made a lower high before the NASDAQ here like a week ago or something like that. But Bitcoin also bottomed way before the NASDAQ bottomed last September, October. So again, Bitcoin has leading indicator qualities, if you will. It's volatile. It's volatile also. Just be mindful of that. Okay. Now, what we haven't done yet, and it's possible that you and I just spoke to ourselves, which wouldn't be the first time. If you guys can hear me okay, and you can hear Brian, if you give us a quick yes in the chat box, that would be tremendous, because otherwise we have just basically literally just spoken to ourselves. If you guys can hear us, yeah, it's not the chat box, it's the questions box. I always get that wrong. Just a quick yes if you can hear us and you can see the screen. The chart, what you should see is a slide right now. I just removed all the charts, but you guys can hear us. Just a quick yes would be much appreciated. So I'm going to quickly wait for some of those here, Brian, before we get going. but then I think we should be ready to roll. Oh, I see. There you go. Excellent. Excellent. Okay. Meanwhile, quick update on my voice for those people that were asking earlier. It's coming along. I appreciate it. I lost it last week. I'm gonna try to see if Brian can do more talking than me, which is always difficult because I just talk too much. But we'll get through this. So I sound a lot better than I did like even yesterday. So should be good. Should be good to go. Let's see here. Okay. All right. All systems are ready to go. Okay. All right. Thank you again, everyone, for joining here today. We've got really a busy, a busy time in the markets. For those people that came here a few minutes early, we just walked through kind of what's going on right now in the market. Some of the good things, some of the more concerning things, and everything in between. And we're going to give you sort of a roadmap here in terms of what we feel like is a really good strategy here for this kind of a market here as we are right now. Quickly, risk disclaimer. This is important. Maybe quickly read this if you could. Trading and investing carries a lot of risk. Make sure you never trade with more money than you can afford to lose. It's a serious endeavor. So make sure you get educated on it. It's not fun and games. It's not about YOLO. Sadly, lots of people treat it like this right now, but that'll cure itself over time. But in all seriousness, trading and investing is a risky business. So make sure you take this serious as you can. Let's see here. All right, good. Yeah, let's see. Get started here. This is yours truly. Part of what I believe about the market is that mean reversion is a real thing, and we're seeing a little bit of that here as we speak in markets, but also being linearly and directionally exposed a lot of times can cause problems, particularly as it often leads to a lack of income. And over the course of my career, whether it was at JP Morgan or throughout the buy side stints and careers, I should say, and now here at the Steady Trader and at Blue Marlin, I continue to see that very much being the case. That there is a big income component focus that most successful investors that we speak with tend to build into their portfolios. And speaking of income and successful investors, Brian, introduce yourself.
Hey, everybody. My name is Brian Terry. I am a 30-year veteran of the finance industry. I am also a certified financial planner and a registered investment advisor. And I've been working with Surge probably about 6-7 years now. And it's just been a ton of fun. And, the strategies we wanted to share with you today are stuff that, we've been working on for years. And we look forward to sharing it with you.
Thank you, Brian. Appreciate that. So I would say let's just get started. I guess the best way to start is to build a little bit of perspective, and we're going to go through things here quickly, but in the proper order. If we do the math right, there are about 1,200 to 1,600 income opportunities each year as it relates to stocks in the S&P 500. How do we come up with that? Well, let's dig a little bit deeper. Typically, somewhere around 80 to 90% of companies' stocks in the S&P 500 pay a dividend. So if you extrapolate that down to the month or break it down to the month, roughly, about 30, 40 stocks a month pay a dividend. And if we break that down even further and realize that a lot of these companies pay on a quarterly basis, we very quickly see that there's an opportunity here to generate income every single month with these dividends. But of course, what we talked about earlier is that this is about doubling the income, or doubling the payout, or doubling the yeah, I guess the income is the best way of putting it. And so we'd like to show you how we like to do that. So with our double income calendar system, we're looking at basically getting double paid. And I'm playing with words here. The key word is double, right? If you haven't noticed yet. So that's kind of the point. But if we go into this and just look at the month of May, we're looking ahead here into the month of May. And maybe Brian, you can give us a couple of words on this. You were kind enough to provide this to me earlier today. Kind of what this is, and these are just some
Sure.
of the opportunities here as we look at the month of May. Maybe give us a quick notice of what this is, and what
Sure.
those numbers actually are.
So what we just listed here are these are probably the top 15 stocks that have that go ex dividend this month. And so, like on the top right, you have ExxonMobil, pays a 95-cent dividend every quarter, or around that 95%, which equates to about a 3.22 annualized rate of return on top of whatever gains the stock may have. So these are some really, solid companies in a lot of different industries. You have, Qualcomm, you have Texas Instruments, you have some utilities, some financials. And, what we try to look for as we get a little more into the presentation, if we can get a 2% annualized dividend, that adds a 0.5% to our gain, what even if we hold it for 2 weeks. So that's kind of what we kind of base a lot of our system on.
So these are just some of the opportunities in the month of May within stocks of the S&P 500 paying juicy dividends. Now, that's just the dividend, right? That's not yet the double stuff that we talk about. But to give you a bit more visual aid around this line of thinking, here is kind of what we try to do. So our goal, and I say goal, right, is to, with income, so talk about the strategy here, add, let's say, another 8 to 10% on top of the portfolio or index return. So let's say the index or portfolio of any given person is the S&P 500. The S&P makes, let's say, in any given year, 8%. Adding another 8 on top of that, even though I can do the math, is about 16%. So now we're looking at a double. Now, one thing that we are going to talk about here in a little bit is how we can lever all of this, right? Some of you guys might be interested in that, some of you guys might not. We're just going to show you how that kind of compares. Both things are possible, but there is also an opportunity to kind of double. This is double the return above what we're trying to achieve. So instead of 8 to 10%, 16 to 20% on top of the index return again. That's not a guarantee. It's simply what our goal is, right? And so again, if you look at this blue line being, let's say, your a portfolio or the S&P 500, our goal is to have some return above that within this vicinity that we just talked about. Not to foreshadow sort of too much on this, but to give you a couple of little points here. What we're going to start talking about here is something called a covered call. And we like to juice that covered call, which is what our double income system is all about. But one way of doing the covered call is by doing something called the poor man's covered call. And you can see the difference in returns there. So if a covered call on average makes 2.5% every 2 or so weeks, a poor man's covered call, by our history, is more like 24.5%. And so if we compare this side by side, Brian, maybe you can give us a couple of words on this. This is the same chart
Sure.
slide I showed you a second ago, except this is now in words.
Yeah, so our covered calls, what we generally will try to do is sell, buy the stock, particularly if a stock has a dividend coming up, sell a call on it, And our average, since we have been tracking these, and even previous averages, about 2.5% every 2 weeks. So we try to keep our trades about 2 to 3 weeks is how long we generally like to go out. Now the poor man covered call uses a lot less capital, but has generated a really nice rate of return, about 24% in a 2 week period on average. And so what we will tend to do on a poor man is devote a certain amount of capital to each trade and generate income via that strategy as well.
Very good. So this is, I think, a good base layer to start off with, but we need to just dial it back just a touch, because I think one of the things that a lot of people would do well kind of getting a refresher on is, what does a payoff diagram look like? So this is a very simple payoff diagram if we buy a stock. I'm sure many, if not all of you, have bought a stock before. And if we buy, let's say, 100 shares at $100, the stock, of course, has to go higher for us to make money. In other words, if it doesn't go higher, we're not going to make money. Cost basis is $10,000. 100 shares at $100 is $10,000 of capital invested. The drawback with a stock on its own, forget the dividend for a minute, is that there's little to no income. The stock has to go higher. There's no insurance. And ultimately, the stock, again, it has to go in one direction, meaning up, in order for us to make money. But of course, that's also the benefit. If it goes up, we do make money. So that's the good news. What we have learned over time, not only for ourselves, but also throughout the course of our careers, Brian with his path, myself with my path, and talking to clients of all walks of life, really just almost around the world, is that there is a need for income in a portfolio. And I'm sure some of you are nodding right now, not nodding off, but nodding, meaning like, yes, I do like income. I like that idea. And so when we expose our portfolios, our monies to the markets, we're exposed to the top half here in this on this slide, which is money. The portfolio fluctuates, and hopefully over time it goes higher. But along the way, we feel it's important to be able to collect income coupons along the way. So picture this almost like clipping a coupon down below with these green little sort of coupons. What we can do, though, is we can actually combine the best of both worlds, stocks plus options, to achieve that goal. Again, our goal, roughly speaking, is to add, let's say, 8 to 10% to portfolio income roughly every 21 days. The classic way of doing this is something called a covered call, which really is a very straightforward concept, a very good concept, we tend to believe, where we simply buy a stock and we sell an options call against that. Brian, if you could walk us through a little bit what the basics of that is, and then we're going to quickly start moving into what it looks like to go into our double income system as well.
Sure. So in this example, you would buy 100 shares at $100 a share, and we would sell the 115 call. And for selling that 115 call, they're going to pay us $2 or $200 per 100 shares. So the most we can make on the trade, no matter where the stock moves to, is $1,700, which is the $15 of appreciation plus our $2 of call credit. And our basis in the stock is $9,800. So we paid $10,000, but when we sold the call, they gave us $200, so we reduced our basis down to $9,800. So that's kind of the basic diagram of a covered call.
Straightforward enough, I should say, right? But also, I think what's crucial here is to see that there's a buffer, meaning that not only do we generate income, but because of that, also there's a buffer, meaning the stock doesn't have to go ultimately exactly into one direction. The reason why this works, at the very core, simple principle of it, is that people are happy to pay us money when we sell someone an option. And the interesting part about that is that lots of people out there, the majority of people that are home gamers, do-it-yourselfers, are more interested in buying options for the, you know, for the thrill of making a lot of money. Whereas if we sell an option, we actually have a much higher probability of making money, of an income, if it's done right. And that latter part there is important. It's got to be done right. If you want to get even more technical, just for 1 second, I don't want to scare anyone, but the reason why option selling, in principle, if it's done right, and again, many people do it wrong. In fact, I would argue most people do it wrong. But if it's done right, the reason why it works is because of the distribution of options pricing. Meaning, we typically get paid more than the adequate, the appropriate risk that we're taking. So we're getting overly compensated generally by selling someone an option. And if we combine that with a stock, and then we'll combine it even further in a minute with our double income system, we have, we believe, a really solid system to look at. So the benefits of a covered call, maybe Brian, if you can walk us through this one here, that would be great too, because I think this is really, really important stuff.
Sure. So, a covered call is probably one of the oldest strategies in options, and there's a reason why it's the oldest, because it works over time. They're easy to put on, or they save time. They're easy to implement. They're very, you can, use it almost on any size account. It can generate income on existing stock, portfolio overwriting. We work with a lot of clients that have existing portfolios, and we teach them how to sell calls against that for even additional income. It also reduces the basis in the stock. So every time we collect a credit by selling a call, we reduce the basis in that stock. Just like that first example, we bought it for 100, but the basis was 98 right off the bat. And then the premium collected helps offset, losses. So if that stock had dropped from, 100 to 99, we'd still make a profit on the trade. So we can use the credit to provide additional downside protection. We talk about that a lot in our system, is how much downside protection do we have, and what's our annualized return?
Yeah, exactly. Now, to be fair, it's always important, and this is also for compliance purposes, we always have to look at both sides. Everything has pros and cons. So some of the drawbacks of the covered call is that we do have to buy the stock. We could miss out on potential gains if the stock goes vertical. That's more of a fear of missing out problem to have. That's actually not really a drawback, to be quite frank, but we'll throw it in there just to be fair. And obviously, ultimately, if the stock really collapses, then one could also lose money. But there's a lot of ways around this, and that's what we're going to talk about. So again, the covered call, if it's properly done, properly set up, most of these risks can be mitigated dramatically. So the covered call is a strategy that allows us to generate income while also owning a stock. Let's give you a couple of examples. One example that I think is very straightforward here is one with ExxonMobil. So if we compare, for example, the dividend yield, this is how much dividends the SPY ETF pays. It's very low. It's about 1.6% per year. ExxonMobil, if we were to do a very simple covered call on that, every 18 days, it's like 2.9%. So if I were to do a covered call on an ongoing basis on ExxonMobil, it pays about 2.9% in returns, and that's not even taking into account any dividends, which we'll get to here shortly. So the way this would look like here would be, just to give you a couple of examples, is the following. We built a risk calculator, a proprietary tool, and we're happy to give you guys access to this later on. But you can see, for example, if we were to buy a covered call on, let's say, in this case, Applied Material, we have the return potential of, in this case, 2.3% in 11 days, and that very quickly adds up over time. And that's not something that right now is attractive to lots of younger people who are very much interested in extremely volatile assets. But this can really help us build a portfolio of income over time. So one thing we can do, though, I want to get right to it, is we can double the capture here. We can get paid double. And this is really our get double income, double paid, dividend captured covered call strategy, where we're taking a stock, we buy the stock or we own the stock already, maybe in our portfolio, we sell the call, and then we also get paid a dividend on this. Now, we haven't even talked about how to leverage all this, which we'll talk about in a few minutes, but let's go through the basics of this, because this is really, really important. So what is the dividend capture strategy? Brian, if I could ask you to
Sure.
go through this.
Sure. So our the way we look at capturing dividends via this strategy is we're looking every week for stocks that have upcoming dividends and that they meet our criteria for a bullish trend, good solid stock, good open interest and liquidity. So we structure our trades so that we buy the stock and then we hold the shares long enough to collect the dividend, and then we usually have our shares taken away by selling a call after the ex-dividend date. And it's a repeatable strategy. We update our watch list every week, and probably about half the stocks on the list are dividend capture trades.
I should say that a little bit later on here in the presentation, we're going to give you our current watch list of dividend capture stocks, the double income. So if you hold on here, we're going to give all of you, as a thank you for being here today, our watch list that we are having literally right now. Also, if you're just joining a few minutes ago, we gave everyone the dividend income opportunities for the month of May in all the S&P 500 stocks. So if you didn't catch that, we will look to bring that up again later if you just came a bit late. But let's quickly go back to our dividend example with ExxonMobil, our income example. Remember, we compared it to just owning the S&P 500, which has a dividend yield, meaning the S&P pays a dividend, the SPY, like a very small dividend of 1.6%. At least it did a little while ago. It's probably not that different right now. On ExxonMobil, though, if we do a covered call double pay income strategy trade, which is what we like to do, you can see that in 18 days, forget 12, 365 days, 18 days, we can do about 3.67% in this example. And that is a huge difference between what a lot of people do when they buy a stock, when they're not really focusing on the income part of it. And over time, this makes a huge difference. It can make a difference between retiring at 50, 60, 70, or literally not retiring at all. So let's give you an example in gold. Now, gold has been a little bit more volatile over the past number of days, but we very much think that this year gold is a bullish trade. We've seen gold break out materially already this year. In fact, this is the updated chart. Here is the long-term big picture chart. We've now broken out of this to the upside, but there's, in our view, a lot more potential on the upside for gold. They're looking at the GLD ETF here. And so one thing we can do with a covered call strategy is we can actually generate income as the stock continues to ascend, or in this case, the ETF, or even if it goes sideways, or even a little bit against us. Brian, if you could walk us through, this is a current, like literally up-to-date example on GLD if one believes that gold goes high. Because remember, gold doesn't pay a dividend, and the GLD doesn't pay a dividend, but there's a way to create that dividend. And Brian's going to walk you guys through quickly what that looks like right now as an
Sure.
idea.
So in this, Serge and I were working on this presentation and we wanted to just put a real life example. So, excuse me, gold was at 212.45, and this is the calculator we have on our system. And we were selling the 215 call And for that, we would collect $2.17, and that expires on May 17th, so about 3 weeks away. So the results are it will, if it gets to 517 by, I'm sorry, if it gets to $215 by the 17th of May, we're going to make $472 per 100 shares, which is a 2.24% rate of return, um, 48% annualized. And the other important thing is now the stock could drop, or the price of the ETF could drop 1% before we lost any money on the trade because we got paid for selling that call. So that's kind of the basis of just a really nice covered call setup.
Yeah, very straightforward, and it just shows you the power of being able to generate an income on something as plain and simple as gold. Now, before we get really excited here about leveraging this entire system, if you will, let's just quickly remind ourselves that what our goal is with all of this. Our goal is to generate a source of income that ultimately results in our portfolios, hopefully giving us a much better return than, let's say, the S&P 500. So we get the S&P 500 returns, and then on top of that, you get another, 8 to 10% is kind of our base case using the covered call or double income strategy. But again, we can leverage this. Now, I do need to preface this by saying that by leveraging, we also have volatility risk. It's a risk disclaimer in terms of compliance and all that stuff. However, let's talk about this because it's one of our, I would say it's probably one of the favorite, if not the favorite strategies right now of our clients. And so let's have a look at this. Because one of the things about the double income system that it requires is, and that's actually a benefit for most people, is that we have to own the stock. Now, for some people who like to be a bit quicker though, there is a way to do all of this by being even more capital efficient, meaning without having to buy the stock. And so we call this thing the poor man's covered call. In fact, that's not our invention. That's a word that's out there. Essentially what it is, it's a leveraged covered call. And so here is kind of what this looks like if we peg these two ideas together. The capital requirements between a traditional covered call versus a poor man's covered call are dramatic. Meaning a traditional covered call doesn't have to be, but it can be expensive. So if I buy 100 shares of a $50 stock, that means I have to pony up $5,000 of capital for the 2-week holding period or so. It's not much, but it is there. The poor man's covered call would be like a lot less, let's put it that way. And to kind of show you this in sort of maybe less numerical terms and more words, in a traditional covered call, what we're doing is we're buying 100 shares of the stock, and then we sell a call option against it for income. And if we do the double income strategy, we would then also capture a dividend if there's a dividend payment. That's the double income system, which we love so much. But we did think that we should also show you here today as a bonus what the poor man's covered call looks like, because here, instead of buying 100 shares, we're buying a longer term call. So we're buying a call option, and then we're selling a shorter term call against it in a very specific way, which I think Brian can show you here over the next couple of slides. So Brian, if you can maybe walk us through the next 2 slides here, I think that would be fantastic. And I would encourage everyone to take some notes.
Sure. So I'll start by saying there are lots of different versions of this poor man's covered call, or a diagonal call is probably the official term of something like this. But we start off by buying an out of the money call 45 to 60 days out. So we are looking to buy around a 40 delta strike for our first step in the process. And then against that, we're able to sell a less out of the money call 7 to 14 days out. So the first step really enables us to almost like a synthetic stock in that we can sell calls against it. And then we're looking for a move higher on that by selling calls so that we make money selling the call, and we also make money on the long call if it moves up to that first strike. So it's a call spread, and it's using different strikes and different expirations.
And so here's a really good example, Brian, that you created that
Yeah,
juxtaposes a regular cover call versus the poor man's cover call on the right-hand side, the
yes.
difference in cost and returns.
Yeah, so we just tried to, compare. We just stuck with SPY. So, at the time, SPY was at 476.50. We sold an out of the money call of 483, collected a dividend. So the most we could gain on that covered call setup would be $740, or about 1.56% in 9 days, 63% annualized. A great setup. You could do the same um, type of trade using a poor man covered call, where we are buying a long call and we pay a price for it, we pay a debit for that, and then we're able to sell calls against it and collect credit. So in this particular case, our net cost was $613. And what we calculated was, if the price of SPY moved to 483, we would gain about $253 against our cost of 613, so a 41% return. So different return, percentage much higher, the return lower, but the cost of being in the trade is substantially lower.
Yeah, and again, this is one of those things where one can do either, or we can even do both, meaning there's an opportunity here to generate an income with our double income system, get double paid with the covered call plus the dividend payment. And then on top of that, one can also consider doing the poor man's covered call. And I know there's a few questions here around dividend payments and things. We will address those. So do not worry, we will definitely get to it. But that's sort of a good starting point. Now, if we compare these two, uh, uh, the more actually, this is just giving you some ideas of some trades that, for example, you recently did, Brian. Maybe you could walk us through just a couple of these here. This is an Oracle, a poor man's cover call. What this looks like.
Sure. So in this Oracle trade, we bought a March 120 call, and then we sold a February 2nd 119 call. The cost per credit, per contract, was $277. So you're able to participate in selling calls against Oracle for a fraction of what it would cost, to buy them.
Yep. It's just really important to understand how powerful this can actually be. This one here's another. This is what ended up actually happening on that, right? I think it was a 39% return on risk in 17 days,
Right.
without having to actually have to buy the stock. So that's a very powerful testament to what you can do. Um, Brian, people are asking, can you do this to the downside?
You certainly can. In fact, we have a poor man covered put in place on our active trades using, I think it's XLK. So yeah, so you can do it both ways. And so a lot of times you can actually do even better on the put side, because volatility goes up when the stock price goes down as well.
Yeah, isn't that right? Let's go through a couple more here. Here's the cover call on Oracle. This is a trade that you did. You sent out this specific instruction email, exactly step 1, step 2, buying the call, selling the call, what the net debit is of the stock, and then when you sent out another email to close it, this is what that looked like, exact instructions and the returns of that trade. So let's just kind of look at this. This is an example of where we're taking a covered call in Oracle, and you are comparing this classic covered call versus what it would look like if we did a poor man's covered call. So this is a really, really good example of just comparing those two.
Yeah, so it just, it just shows you on the covered call what the costs are, what the overall percentage is. So the covered call is very straightforward. You buy the shares, you sell the call, and it's easy to calculate, and hopefully we capture the dividend. So, but it has to get to be 120 or higher to reach our full profit on this particular trade.
Exactly. And then if we look at this through our risk calculator, again, we'd like to give everyone access to our covered call calculator here afterwards as well. And again, as a bonus for everyone that attended, we will give you our current watch list, and we'll also talk about show you the income opportunities in the month of May that we flashed earlier at the beginning of the presentation a little while ago, so everyone gets a chance to see that a second time. So you can see how all we have to do in our risk calculator is type in the stock, the entry date, and the parameters, and it gives us exactly what's the rate of return potential, where's the break even, and all the other data that we need to know. So on the poor man's cover call version of this, you did the same thing, except here we didn't have to put up 10,000 bucks for the trade, right? I think that's really what it comes down to.
Right. And the other thing, Serge, on the poor man covered call, if the stock price doesn't get, in this particular example, 149 by the 16th, we have the opportunity to either roll that call out another week or let it expire and sell a new call on it. So you have a lot of flexibility. I always call this like a game of chess sometimes in the poor man's covered calls, because you can roll it, you can, and your goal is to continually write off the basis of that stock so you make a profit at the end of the trade.
Exactly. So this is what you did here on Google here. You can see where the alert went out, and then when you closed it for a 34.67% return.
Mm-hmm.
Same thing here in Google. The alternative would have been the classic cover call. We quickly touched on this before. Here, the return was, or the maximum possible return was 8%, and you can see how that looks. Let me quickly just talk about the mistakes here, and we're gonna go through a couple other things here. I want to really make sure everyone understands the power of this. Can I get a quick yes for those people that can see the power of something like this? Right, so we have the double income system, and then if we're going to lever that, get the double paid, get paid twice income system. On top of that, we also have the opportunity to go in and lever this entire trade with a poor man's covered call. It's very, very powerful. Now, a couple of mistakes I think that's important to avoid, Brian. If you could walk us through these,
Sure.
These are really, really important.
Yeah, if you just avoid these 5 mistakes, you're going to save yourself a lot of money. First is holding a trade through earnings or a major event, particularly earnings, because what can happen in a stock price, it could go, shoot up or shoot down. And we just don't want that kind of additional risk that we can't control when we're dealing with covered calls. The second thing is you want to make sure that the stock and the options have good liquidity and open interest. So that's kind of the other thing. You don't want to trade illiquid stocks or stocks with really wide bid-ask spreads. The third thing is something I see a lot, Serge, and I know you do too, is that some companies will pay unbelievable dividends percentage-wise. And if you look at the fundamentals of the stock, they really don't even earn enough to pay out those dividends. So those are just, chasing rainbows. I kind of say that, we want to look at good dividends in good stocks with good liquidity. And you don't want to be selling uber short dated options And then the last thing is you want to be diversified. You don't want to all be in tech or all financial in your portfolio of covered calls. So you want to make sure that you're looking at, what other stocks or ETFs do I have that I don't want to be over, heavy in one particular sector. I see that a lot as well.
I think that latter part is extremely important. Now, before we continue along this, I know there's a bunch of questions. We're going to address all of them. People are asking about, what kind of returns. Well, obviously, we have to go with a disclaimer. We can't, past performance is not a guarantee of future results, all that kind of stuff. And obviously, none of this is advice in any shape or form. It's just education. But I'd like to share with you, and this is straight from the members page, members area, what this looks like, and so you can kind of see the results in all of this. So I'm just going to go with the covered call close positions, and all you have to focus on here is on the column that is right there. So you can see over time, I think we're probably about 8 out of 10, maybe even more, honestly, maybe even be close to 9 out of 10 trades that make money. And you can see the constant 2, 3, 4% returns. These are just the classic, the double income system that we do, right? And how that really adds up over time. Now, if you look at the poor man's covered call, of course, because this is a levered version without having to own the stock, here you're looking at a much larger return. So you look and see, for every good solid loss we have probably like 10 winners or 9 winners, right? So it really is high, right? You look at all these 25%, 37%, 30%, 30%, minus 20%, up 18, up 30, up 20. And it continues. I mean, there was just the past number of weeks, you can see was like, what is that, 50, that's like north of 65% worth of gains on this. Is there anything that I'm forgetting here that I should be adding, Brian, on just on this part here?
I think on that particular slide right there, Serge, I broke out because one of the things that on our cover calls, a lot of our members said, hey, can you give me a poor man's cover call version of that? So I started, like you had mentioned, sometimes we do the cover call and the poor man. We pretty much do that on every trade now. So that second list would be the bottom list is just poor man cover calls that we did on official cover call trades, if that makes sense.
It makes a ton of sense. And I think that's really important to understand, right? That when you do these trades, one can express it most of the time, or a lot of the time, as a covered call, double income opportunity. And I want to go and show everyone our current watch list in about maybe 2 minutes or so. So you can kind of see what we're looking at right now, but also can be expressed as a poor man's covered call. And so that gets us to the checklist. Again, we don't want to trade very, very volatile stocks or ETFs with this. I think that's difficult. We want to avoid very low priced, extremely volatile stocks, and we don't want to hold stuff through earnings. That latter matter there is really important. And so we really want to make sure we don't gamble with this. There's no reason to gamble with this strategy. It's not a gambling strategy. So when we look at this in a portfolio context, what can we kind of expect? So we promised you before to show you a watch list, right? And the watch list we're looking at right now consists of this. I don't know if you have any comments on this one, Brian, but maybe if you want to highlight just there's a few double income opportunities in here. I see 4 of them. Yep. Just literally right now. This is like over the next like couple of weeks. Yep. Maybe if you could spend like a quick minute on this.
Yeah, so the way we build this watch list is we write down where the stock or ETF is trading, what strike we would recommend selling, what expiration, and how much credit. And then, like you said, there's 4 dividends on there this particular week. And then we break it down based on return on risk. So Hasbro has a 4.12 return, 83% annualized, and it has 3.21% of downside protection. So that kind of tells you, the stock could actually go down some in price and we could still be fully profitable on the trade, where the break even is, and then we'll list out, when is it go ex dividend, what's the amount of the dividend, and then um, what's the annualized rate of return. So, and then sometimes I do all this research all over the weekend. So sometimes the option chains don't have great bid ask. They're a wide bid ask. So if I'm doing it over the weekend, I'll just put down that, hey, this was a wide bid ask. But other than that, I'll put down when it goes ex dividend, what the dividend is, and what's the annualized. And then on the second one from the end, Met actually is a different one. It has an earnings event on 5/1, but then it goes ex dividend on 5/6. So what we would look to do if this still set up after the earnings would be to put the trade on after 5/1.
Very important, right? So again, with our rule of not holding these trades through earnings. Now, this is our current watch list, and maybe some of you guys want to take a picture of this. Remember, this is not advice; it's simply through the lens of education here. But this is a current watch list, the current watch list, like literally right now that we're looking at. You can see we have 4 candidates right now for the double income calendar system, and then a lot of these can also be done with the poor man's covered call, which is a levered version of all of this. I want to show you one other thing as another added bonus. And as another added bonus, I'd like to show you what some of the stocks are that not only are interesting for covered calls, but more specifically also pay really good dividends. These are something called dividend aristocrats. Again, these are just some of them. You guys can take a note of these. These are companies that have increased the dividend for 20, 25 years in a row. That's a long time. And offer a really good opportunity, we have found, to do the double income calendar system that we have referred to here before. Okay, so that's one thing that I think is really important. One thing that I also want to show you, and Brian, maybe you could address this quickly before I go into the risk calculator. Some people are asking, how long do you hold these positions? What is the average holding position for your trades in general?
Generally, it's going to be between 2 and 3 weeks. So like this was stuff, these were all trades that would potentially be made this week. And we were either using the 5/10 expiration or the 5/17. And the reason there's a difference is some of the stocks only offer monthly options. So we used the 5/17 in that thing, or sometimes the liquidity wasn't good enough in the 5/10. But I generally will go out about 2 weeks, 3 weeks max, because what hopefully we can do is put this trade on, and then in 2 weeks reuse that capital in the same month.
Yep. Quick clarification. Jeffrey's saying we said not to use ETFs. No, absolutely not. We said yes to use ETFs.
Yeah,
in fact, ETFs are an integral part of this. Yep. Like we gave you the gold example before, right? But what you need good liquidity. That's really, really important. Now, what we would like to do is we would like to give everyone, and I'll show you the trades again in just a second. Some people are asking. We would like to give everyone access to all of this, including the trade alerts, but also the risk calculator. So we developed this tool in-house. It's on our members area, where all we have to do is when we have a new covered call, we type in the ticker, the expiration date, the options information, and if there's a dividend, then we put in the dividend information, and it spits out our exact cost basis, max profit, risk, everything you need to know. We even have dividend information on every single stock here that are worth doing. In this, I'm just having Apple up here. Earnings, dividends, everything you need to know to put this on. Again, this is all in addition to actually doing the trades, the trade alerts that we send out as well.
Hey, Serge.
Yeah.
One thing I was going to say too on this one, when you're playing with the calculator, and say you're looking at a trade on Apple and you want to compare 2 different strikes, it's so easy just to change the strike and the credit amount and then look at the overall results. So I use it all the time for that. I want to see like, okay, if I drop it, if I go up another $2, what does that do to my return and risk? So it's very user, you can use it a lot for multiple, examples.
Absolutely, and it's an important part to what we do. Now, let's just have a quick look at our positions. I don't want to show people the open positions. I believe that's would be unfair to current members. But let's just quickly show you again, so you can kind of see what this looks like on the closed position front. So again, this is the classic covered call. You can see on average, 2-3% or so of gains each one. And again, this is gains every 2 weeks, right? That's our goal. You can kind of see what that looks like. Very, very steady positive returns. Again, it's the income we're looking for here. And remember, income is something that is compounding. On the poor man's cover call, this is what it looks like here. Let me quickly flip over to the right column, and you can see what the returns look like here. Again, a lot of 25% returns, 30% returns. There's a down 20% return that was literally made good again the next trade, and then up 30% and 20% again. So that's kind of how all of this works.
Yeah.
Now, yeah, please.
Hey, Serge, on the poor man's cover call, what I've kind of learned over time is because some of these stocks, it might cost you $5 to put one on or $2 on another. I try to allocate the same amount of capital to each trade. So I'm buying, maybe 3 on one, 10 on another, just so that you're getting using the same capital amount on each and every poor man's covered call.
Yeah. That's risk management, right? And I think that's an important part of all this as well. So look, if you guys can get excited about the income opportunity that there is every single month, let me just go back and just show you. In addition to our watch list, these are income opportunities, just some of them right now here as we look at the month of May 2024. These are beautiful income opportunities where we can do our double income strategy. And then, of course, again, also the poor man's cover call, which have, what is it, roughly about a 10x return on a poor man's cover call versus the double, right? Yeah.
Mm-hmm.
Yeah. So, in terms of where to start, I typically say it's a great way to start with the alerts, follow those, and we only do the ones that we like the most. Out of all these opportunities here in May, we're not going to do every single one of these with the double income system, but we will send you an alert on the ones we like most. But there is so many opportunities. It's literally, every single month there's 30 plus companies paying dividends just in the S&P 500 itself. Now, one question that we saw before, and this is always a bit of I want to bring it up because I saw the question a couple times. What happens when a stock pays a dividend? Does the stock drop? The answer is the stock could drop, but typically speaking, it bounces right back. I don't know if you have any thoughts on that, Brian.
Yeah, no, I think that, that's people who are used to dealing with certain ETFs or mutual funds. When they declare a dividend, it automatically drops an equal amount to the amount of the dividend. With stocks, what happens is it really is all driven by the market. So a lot of times it may initially drop, but like today, I think we had one in Morgan Stanley, and it was a dividend. We collected the dividend, and the stock actually moved up initially before the market, kind of sold off. But it's going to be more market driven than just an automatic deduction in the stock price based equal to the amount of the dividend. Hey, Serge.
So yeah, so there's a lot of misconception out there around this, and I'm glad you're able to clear that up. So I hope that addresses all the questions. So what I'd like to do is I'd like to give everyone access to our trade alerts here. You can see what people are saying even inside the chat room. We're actually doing a separate chat room on this here very, very shortly. That's dedicated to just the cover calls, implement cover calls. You can see Brian there when he closed one of these trades there, and what other people did as they followed him in this as well. But these alerts get sent out by email, and they get sent out in the chat room as well. Depending on whether you want to be in a chat room or not, of course, that is up to you. You don't have to be in there to get the alerts. Again, the difference between the traditional cover call or the double income system is that the poor man's cover call gives us a lot higher returns, but also you can't capture the dividend because the poor man's cover call does not own the stock, so we can't actually get paid a dividend. So a combination of these two is really what we think is a great way to start. If you're thinking about cost, so 1 cup of Starbucks tall latte right now, and it's actually gone up since. I know this is not New York City prices, but these are sort of average U.S. prices. It's gone up a little bit since. Is about $3.50 per day. Our dividend, our cover call alerts, emails cost. It's actually less than this. Actually, I did the math again last night. I think it's $2.40 a day. So you have real-time cover call, double income system alerts, and permanent cover calls, including the risk calculator, the weekly cover call watch list, and the monthly member webinar, which we'll talk about here in a minute. So the question is, what's more important to you, right? Is it growing the portfolio, learning new strategies, implementing strategies that have a successful history, or do you just want to have a sugar high? Again, it's an honest question, and I don't mean sugar high, I mean a caffeine high. So here's what it looks like. You can see when an email alert goes out specifically, there's the exact step 1, step 2. This is the call we buy or the stock we buy. This is the call we sell or the call we sell against the stock. Specifically, what's the reason for the trade, access to the members area where the trade is posted in more detail, and then an email gets sent out in real time when this is sent out, when this is closed out as well. So here is what you get started with right now. When you get started with us, I should say, you get real-time trade alerts. Again, that's on the poor man's cover call, the cover calls, and the double income capture system, the dividend capture. The first 20 people are going to get access to the position calculator as well. So if you want to get access, and you also want to get access to our cover call calculator on the website, you'll just have to be one of the first 20 people, that's all, as a bonus. And you also get access to the top 10 cover call watch list, each week fresh, and the monthly member meetings. So the first 20 people will get access to all those bonuses, including a trade tracker spreadsheet. What we're also going to start doing at the beginning of every month is give you a list of stocks that are paying a dividend that month. That's another bonus and another great reason to join us. So the question, of course, is how do you get started? For 365 days, so that's for 12 months, you can get started for just $7.97. Remember, this breaks down to, I said it's $2.40 something cents a day. You can do that by going to steadytradersecrets.com/PPIS, or you can call the phone number 401-203-7389. Now, everyone in here is going to get a real-time onboarding phone call by one of our team members. We're also happy to get on an onboarding phone call with you if you have questions about how you want to implement this with your portfolio. That will be with either Brian or myself. Remember, you get access to a full 12 months to both the double income trade calendar income system, the cover calls, and the poor man cover call trade alerts. Every day there's an alert from what I've seen, Brian, right? I mean, sometimes it's a poor man cover call, sometimes it's a cover call. Reasonably, we're not going to put one on right before a Fed meeting or something like that,
Right.
or right through an earnings report. You can also use PayPal if you want, and the offer link for that for the first 20 people is in the chat box. If you have any questions, if you prefer to order online, if you want someone to call you back, type in the word steady, STEADY, into the chat box, and someone will get back to you. If you have to run to a meeting and you want to reserve your slot right now, type in the word steady or put your name and phone number in the chat box, and someone will get back to you. And that's also going to reserve your slot, because these 20 slots usually go pretty quickly. The reason we only take 20 slots at a time is because we want people to be able to onboard every single person individually. Again, the first 20 people get access to the cover call risk calculator, as well to the watch list that gets updated every single Monday. So that's there. That's this one right here. And you get access, you even get access to something, I haven't even mentioned this yet before, this thing here is the cover call portfolio tracker. So if you would like to track that's another bonus. If you would like to track your portfolio, we give you access to this special spreadsheet that Brian created that is going to make a huge difference in the way that you track your covered calls with all the specific details that you need with a portfolio, with a spreadsheet that Brian created. So we really are all about research, right? Evaluating the underlying stock, evaluating the reward to risk. Again, we're using the proprietary risk calculator that you get access to as well for 12 months. And it's all about income. That's what the point of all this is. As we said before, as another bonus, we are happy to jump on a personal coaching call with you personally, one-on-one. That's in addition to the onboarding phone call that you'll receive from one of our team members as well. So the first thing that's going to happen as soon as you come on board, someone's going to call you, welcome you on board, make sure they walk you through where things are. And then if you want to, we're happy to jump on a call with you with a personal coaching call as well. So these are the details. Now there's a bunch of questions here, Brian, if you don't mind sticking on just another couple of minutes here that I'd like to go through. Let's see here. How many positions do we have on at any given time? And how many new trades per month, roughly? What would you say?
Sure. So I generally like to have about 3 to 5 covered calls open at any one time, and about no more than 5 poor man covered calls. So generally we add one of each every week, and we're looking to take one off every week. That's kind of the goal. So
Yep.
The watch list gives you the opportunity to say, like if there's additional trades you want to make, the watch list helps kind of guide you in that regard as well.
Next question is by Jeffrey's asking, how is this different from the credit spread authority? There actually has nothing to do with it. The credit spread authority is options credit spreads. This here is covered calls, double income covered calls, and the poor man's covered call. So this is about covered calls in short. The credit spread authority is about options credit spreads. Good question, but very, very different. And then Chet is asking you, when you do these trades, Brian, do you do all three? Do you do a cover call and then lever on top of that a PMCC? How does that work?
Yeah, so if there's, we can only do the dividend if there's a dividend coming up. So we either do a cover call with a dividend or without a dividend. And then a lot of times, I would probably say 80% of the time, we'll do a poor man's cover call on the same stock. So that was because a lot of the members said, hey, I love the trade. Can you give me the version of the poor man? So I said, it's easy enough to just add them both in and track them as 2 separate trades.
Yeah, exactly. Now, it's not necessarily about doubling down on the bet, right? So if you can do a cover call, or a double income dividend capture trade, like you don't also have to go out there and do a poor man's cover call. Right. You can, but just understand you're taking twice the risk, right? So you can, but then what I would do is I would reduce the position size of any of these. Right, so don't double down on the bet.
No. I mean, the reason we added that second one was just to give people an alternative if they liked the trade, but maybe they didn't have enough capital to put a $20,000 trade on. The poor man is the same concept of the trade with a lot less capital.
Yep. And then Steve is asking, Walter was asking, how much capital do I need to start? Walter, if one does, again, I can't say you speak in you terms because that is non-compliant anymore. But if one were to do this with the poor man's covered call, there's not much money required. I would say, you know, whatever, $5,000 just to have enough in an account.
Right,
With a
right.
with an actual
I would,
cover call though, that's a bit different.
yeah, I mean, and we have a lot of the stocks that we put on the watch list are under $100 a share. So, but it's still, if you bought a $50 stock, that's a $5,000 um, investment or in that trade. So the poor man's less capital. Um, the covered calls generates more income and enables you to get the dividend.
Yeah. So I hope that answered the question. It's a good question.
Great
Also, I'll say
question.
that money is not tied up for very long. Typically, these trades are on for like 2 weeks or so,
Hmm.
right?
Yeah.
So, and these are all really, really good questions. Again, if anyone has to jump to a meeting and you want to reserve your slot, because the 20 slots typically get taken up within 30, 40 minutes or so. And if you want to get the bonuses, just type the word steady into the chat box. You can also leave your name and phone number here into the questions box as well if you want to, and that'll also reserve your slot and someone can give you a call back. But you know, just be warned on that. So what's going to happen next? Well, let's have a look at. I want to go back to this example here in gold, Brian, if you don't mind. And again, please keep the questions coming. We'll sticking out around for another few minutes for anyone's questions. But I want to quickly go back to this idea on gold, just to quickly exemplify, you know, sort of how all this works. So if we look at gold, what we're looking at here is this is a breakout trade. So we think gold can go a lot higher this year. It's maybe a little bit overbought right now, but ultimately it has the potential to go a lot higher. It's already broken out in the bigger sense. And so one thing we can do is, because gold doesn't generate an income, we can do a covered call. And the way the covered call would work in this case is we would buy 100 shares of GLD, which, you know, from a diversification perspective in a portfolio, one would pay, right? And that's $20,000 ish. And on top of that, we can continue selling calls on it. So maybe I can talk about this. Like, this can be an ongoing exercise. Like, it's not just done once. Like, you
Right.
can do this every other week.
Right. So something like on gold, you could buy 100 shares or versions of 100 shares and sell calls against it to generate income. So in this particular case, we just went $3 above where the ETF is trading now. But if you wanted to generate income, you on existing stock or stock that you want to buy now and hold for a long time, you can go a little further out of the money and collect an income and still hold the shares.
Yeah. And again, this could be done with a poor man's covered call where the cost is a fraction of that, maybe a few $100 probably, right? That can be done as well.
Yep.
So, and when you send out a trade alert, Brian, it's important to know, if at all possible, and a lot of times it is, you'll give people the option of, okay, cover call, or here's a poor man cover calls version. So if anyone here is on the fence on this, just so you know, you'll get both versions most of the
Mhm.
time, as long as there's options.
Yep.
Yeah, yeah. Sure, yeah, sure. Let's show the numbers again quickly. Just again, the point is to show you what the point here is, the repetition of it all. And so let's quickly go back to this. And Brian, if you have to jump, just let me know, and I'll
I'm
continue
good.
addressing all the questions. I don't want to
Oh, I'm
keep you
good.
too long. Okay. So here's again, just to give you an idea. So the profit pro income system, with the poor man's covered call, here's kind of what these returns look like. And again, these are actual. This is not made up. Obviously, we can't guarantee the future, but this is what literally actually has been done. So you can see these returns. This is the poor man covered call, between 20 and 30% ish returns on these trades on average. And then if it's an income oriented trade, either a double income system or the cover call on its own, you can see we're looking at per trade. But again, this is every other week or so. these are not trades that hold on very long. So the annualized returns are huge. And I don't know if you have a couple of words on this, because sometimes people get angry when we talk about annualized returns, but I think it's because they don't understand that we do have to put it into context for them.
Right. So what we try to do is calculate, what is the rate of return for the period you held it, and then annualize it. So, I think under the covered call, it's been around 25% annualized. Under the poor man, it's, 25% in 2 weeks. So with a lot less capital.
Yeah, exactly. In terms of closing the trade, yeah, I mean, it's really very straightforward. What Brian will do, it'll send out a trade alert when you open the trade, and then when to close the trade. So let me quickly show you what this looks like here when you send out an alert, so everyone can kind of see what this looks like. So here, for example, is an opening of a trade. All right, so step one, step two, like super simple, what to buy, what to sell. And then in this case, a few days later, it's once again, I close it, right? So step one, we buy to close the call. And then step two, we sell the list as a poor man cover call, or just sell the shares, right? So very straightforward again, but that's also why we offer the onboarding phone call, to make sure that everyone gets a chance to to be fully on board there. Sure. Brian, let's quickly go back through the gold trade just so people can kind of see.
Sure.
Again, gold does not, and then this is not a recommendation, right? Just to be very clear, this is just through the lens of education. Gold doesn't pay a dividend, right? So if anyone here likes the idea of owning GLD or gold, right? One way to generate a return on this is to buy some, let's say GLD, and then sell calls against it on an ongoing basis. And that can be done, even if gold fluctuates, obviously, which it does. But it can also be done with a poor man's cover call, in which case we don't have to own GLD. So it can be done in many different ways. Yeah, I mean, Doug, again, it's a question that is, again, it's really bordering financial advice, so I have to be careful in how we answer this. But Brian, I'll pass it to you. Hypothetical $10,000 account on poor man's cover call, you would roughly divide it how into poor man's cover call?
Yeah, I would invest 2,000 in each position. So you had 5 different positions totaling $2,000, dollars each. So for example, if the poor man cost you $1,000 or $10, you would buy 2 of them. And if it cost you, $5 or $500, you'd buy 4 of them. So that's how I do it. And it just makes it real easy to kind of manage them that way, as opposed to, one is, 4 times as high a price. You end up going, I wish I had put more into that trade.
Mm-hmm. Yeah, I mean, and that's the thing, and you will typically just equal weight these, right? So it's not like one position is much larger than another one.
Always equal weighted, even for the covered calls, same thing.
Yeah. So again, if right off the bat, as we come into every single month, the first thing we have is an opportunity to have, again, any given year, we have between 1,200 to 1,600 income opportunities each year. That's the S&P 500 dividend payments. A lot of them are quarterly payments. So a company like whatever XYZ will pay, each quarter will pay a dividend, right? Because 80 to 90% of companies, S&P companies, pay a dividend roughly over the years. So that's right off the bat what we started with. And then with our double income calendar system, not only can we take advantage of that, but we can get double paid by also capturing, by also selling calls on this. And again, these trades hold for 2 weeks. If we then look at the opportunities every single month, and we send this out to our members, so every member in our group gets an email at the beginning of the month telling you what are the income opportunities for the month of May. These are just the dividend ones alone, right? These are just the double income opportunities. It's in addition to all the trade alerts that go out with poor man's cover calls. But that's very, very good to know. And then again, our goal with the traditional cover call and double income system is roughly 8 to 10% above the index. That's a goal. That's not a guarantee, obviously. The difference in returns between poor man's covered calls here in green versus traditional or double income system is quite drastic. And then again, in our world, if we look at this, and I'm gonna quickly fast forward a little bit to just one more slide here. If we look at this through the lens of doing this on ETFs or things that we like, we can do this on an ongoing basis. As we said before, on gold, for example, or if it's a stock that you like, let's say you like ExxonMobil. Like let me go into a live chart for a second and just hypothetically speaking. So let's say instead of gold, let's say Frank likes ExxonMobil. It's a random example, right? Again, not a recommendation, just education. So let's say for some reason Frank likes this chart here of ExxonMobil. Makes sense. It looks like it wants to break out. Gold cuts, energy stocks have some tailwinds, etc. So let's say he wants to buy some of this stock or own some of the stock, right? So many of you maybe have an IRA or some other retirement account where you own stock that you're not getting paid on or not paid on enough. What we can do is just sell calls on a repeated basis. And then if we want to every once in a while, we can even do a poor man's covered call. So those are the advantages of having something like this. This is a scaling question for you, Brian. David's asking, can this be scaled? I mean, the simple answer is hell yes. There's huge mutual funds that do this.
Yeah.
But I'll let you answer that.
Yeah, I mean, the good thing about it is scalable. So if somebody has $100,000, they're going to trade the covered call strategy. They can put 20. If they have $1 million, it's easily, you can just 10x the amount of size. So it's not like it's good for everybody. And on a smaller account, the poor man covered call is a great way to kind of get started.
Yeah, very much so. Yeah, in terms of the trade alerts, just quickly. So what happens is, again, we get in, there's an alert. We get out, there's an alert. It's really as simple as that. Everything is being tracked in the members area. So let me walk you through that. So there's open positions tabs for both the traditional cover call and for the poor man's cover call. So I'm just showing you the closed trades right now to be fair to our members. But of course, as soon as you log in, you'll have access to the open positions as well. The poor man's cover calls again are here as well, open and closed ones. Typically speaking, Brian, what is the average type of stock that you'll do a cover call on or a poor man's cover call? Like, is it a larger cap stock?
Yeah,
Is there a theme?
Yeah, I mean, they're going to be, probably larger size companies because we want that stability and good fundamentals and good liquidity. And then again, if you look at that list of the May dividends, they're all pretty big size companies, and they're in a lot of different sectors. So that's kind of how we look at them. We go through, every weekend, I update our watch list. We screen through them, and then we kind of calculate those out. So they're bigger companies. Very rarely will you see a stock ticker that you've never seen or traded before.
Yeah, I don't think I've ever seen that from you either, and it doesn't make a heck of a lot. By the way, you can also use PayPal, folks. If you have any, if you want to use PayPal, you can do that as well. Again, it's a full year for $7.97. And if you have any questions, you can call Joel. There's a phone number there. Or if you have to run to a meeting, or if you want someone to call you back, just type in the word steady, STEADY, into the chat box. One more thing. Again, all of you guys are getting access to the cover call return and risk calculator that's on the members page. We teach you how to use that as well. There's even videos on it inside the members area, so you're not gonna miss out on that. And again, the email alerts, this is what it looks like. Yes, the alerts get sent out by email. This is what they look like when you enter the trade. Again, very clear. This is what you do, step 1, step 2, and then when the alert gets sent out, another one. Maybe one more question here that I'd like to address, which has to do with the chat room.
Hmm.
We are about to launch a special separate chat room for this. We right now have it mixed with another chat room for another product, but that is about to change. And then the chat room is on Slack, which is an app that everyone can install on their phone or tablet or PC or laptop or whatever you have. And that's where the alerts also get posted. There's also a vibrant community with people that are doing these cover calls, double income system cover calls, dividend capture, and also, of course, the poor man's cover call. So the first 20 people are going to get the bonus here of the cover call, position calculator, the watch list, the monthly member meetings, the trade tracker spreadsheet that I showed you, and also very importantly, at the beginning of every month, we show you exactly the income opportunities from a dividend perspective every single month. We just showed you the list for the month of May, which I hope some of you guys took note of. And we also showed you our watch list for right now. If anyone wants me to flash that up again, I'm happy to do so. But again, if you want to take advantage of this, make sure you do so sooner rather than later, or type in the word steady so that that kind of secures your slot, and then someone will give you a call back. Brian, I'm going to let you go. Thank you for sticking around so long. I appreciate it.
It was fun. Y'all take care.
Have a great day, and everyone else. If you guys have any questions, again, reach out to Joel. You can give him a call at 401-203-7389, or just type in the word steady into the chat box, and someone will get back to you. And it's also going to reserve your slot for all the bonuses as well. Because again, if you order this later and the 20 slots are taken, you're not going to get all the bonuses. That's the incentive we want to give people for taking action here today. So thank you all for joining. Again, I hope it was helpful. I hope income is something that's on your mind. It is an important concept, we believe. So thanks for joining. We look forward to seeing all you guys on the inside. And if you're joining member, you also get an onboarding phone call, not only from one of our team members, but also if you would like to set one up with either Brian or myself, we will do that as well. Thanks for joining. Hope it was helpful, and we look forward to seeing you guys on the inside.